All right, hello everyone. Thanks for checking in. We're going to talk about the markets, specifically the SPY, the S&P 500 ETF, which tracks the S&P 500. But anyway, the market has been kind of crazy over the last few days, and as traders, this is what we're looking for. We want markets that are going crazy because markets that are going crazy move. Markets that are chill don't move, and if they don't move, as traders, we can't make any money. So anyway, let me just delve right into it here. Now, I think that we're going to see a reversal, and I think that this move higher today is kind of a sucker's rally. Now, I could be wrong, and we're going to get to that too. Unfortunately, people ask me for my opinion, but what I would really tell you is don't have an opinion. Let the market tell you what to do. If you have an opinion, oh, I think the market's going to go up, I think the market's going to go down, you get kind of what we would call married to an idea. And that brings in confirmation bias, and it makes you see things that, or it makes you ignore things that you probably should pay attention to, and it makes you overcredit things that you probably should maybe ignore. Now, I'm instead of starting out with SPY, I'm going to start out with the 10-year yields here because this has been going nuts. Now, yields move inversely to the price of bonds. As a matter of fact, this is what long term hurt these banks that are going under. They put their money, or the money they invest, they put it in quote unquote safe investments like treasury bonds. And when there's inflation, the value of the bonds goes down. So the people that are running or were running Silicon Valley Bank and Silvergate, they must be freaking idiots, man. You know, it's like everyone and their Aunt Mary knows that there's inflation. So if inflation is there and it's going to drive the value of your bond portfolio lower, what would a person with a 95 IQ do that just came off the streets and you would talk to them for an hour about how markets work? They would say, well, gee, we should hedge. The fact that these portfolios weren't hedged is really egregious. And what's even more egregious is that these people, all the senior executives at these places that are going to get forced out of jobs, which they should, they're all going to walk away with millions of dollars. And meanwhile, they're responsible for losses of millions of dollars. But anyway, all right, enough of my rant here. Now, this is kind of a ironic move. The reason why yields have dropped so much is because there was pretty much, I don't want to say panic, but panic slash really aggressive buying of bonds. And when we buy bonds, it drives the price down. So the reason why this market has the stock, I'm talking about the stock market now. The reason why the stock market has done well over the last few days is because yields are down. But yields are down because there's panic buying in the bond market. So the fact that lower yields gave the stock market a little bit of a boost, I don't think it's going to follow through, right? I mean, it's like the only reason why yields are down is because of a bad thing. And eventually the stock market will realize it's a bad thing. So now we've seen the reversal, right? We've been up 5% in the 2 days, which is huge in the yield market. So, all right, let me just show you a couple more things. Because I think we're on the chance of a big reversal. And, you know, like I said, I could be wrong. I'm not getting married to a position, but I want to show you what I'm talking about. Now, here is the S&P 500, and one of the fundamentals of financial markets is that some price levels are more important than others. Sometimes we know why, sometimes we don't. You don't need to be a trading master or market guru to look at any chart and see that it's true. Now, this 390 level has been really important. And I'm speaking about the 390 level, right? This is a $390 security. Don't be too precise. It's more of a zone or a range, right? I mean, $5 on the upside, $5 on the downside. That's like what, 2%, and not even. Anyway, we were support over here. This is 390, and the market's going lower because there's not enough demand to absorb all the supply. So the sellers are forced to sell their shares at a discount, and this creates a downtrend. When we get to support, there's enough demand to absorb all of the supply. So the sellers can sell all they want and the price stops going down. Now, how is it that a level that was support turned into resistance? Well, it's because of buyer's remorse. That's the traditional reason. Investors who bought at 390, assuming they held on to their shares when it went lower, a lot of them regretted doing so. So they tell themselves, you know what, I made a mistake. I want to get out. I'm going to sell, but I'm only going to do if I can get out of break even. So they tell themselves, if this gets back to my buying price, I am going to sell it. So if you have enough remorseful buyers placing sell orders at the level that was support, the level that was support converts into resistance. Here we have the opposite. So resistance converts into support. This is because of seller's remorse. Investors who sold, a lot of them regret doing so after the market moves higher, and they tell themselves, I made a mistake, I want to buy my shares back, but only if I can get them for the same price I sold them at. So if you have enough remorseful sellers placing buy orders at the level that was resistance, the resistance can convert into support. Now, why am I going through this whole thing? It was last May, June, July. This is an important level. Why is it not 393 or 387? I don't know, but I don't need to know. The market is always right, and I'm not. Now, the reason why I bring this up is because today's rally stalled out right there. I think it's going to take some work to get through this level. Obviously, it's not impossible, but if we decisively break this level, we're going to go into probably a really tradable uptrend. I'm not saying, the market's going to go to a new all-time high or anything like that, but most of the stock market jobber community are traders. So we're kind of more into shorter term moves because no one knows where the market's going to be in a year. But anyway, notice how we stalled out right there. Now I'm going to bring up a shorter term chart so you can see it better. All right, so this is what we were just looking at, but instead of a year, we're looking at year to date. Now, once again, you don't need to be a market guru, and believe me, on Wall Street, market gurus are a dime a dozen. So they come in and out of fashion all the time. So I wouldn't pay attention to the market guru because you know what? They become wrong. The market is never wrong. Anyway, before I go on a tangent, let me go back to this 390 level. So this is what we just saw longer term. We can see we got support there. And the reason why I'm bringing this up is because we're back up at this important price level. So markets, when they get to these important levels, they tend to make a big move one way or the other. Or I should say a tradable move. They tend not to hang out there for too long. So there's a good chance that we make a big move over the next few days or maybe a week. If we break through, well, if we break the resistance, it will tell us that the investors who created the resistance with their sell orders are out of the market. So once the seller's out of the way, the buyers need to pay higher prices if they want to get things in. If the sellers prevail, we'll probably get a tradable move lower. And that's my suspicion. I think that's what's going to happen. But again, if I was trading and my trading days are long behind me, I'm much more comfortable just teaching people at this point. I was going to retire, and then I was trying to think about like, oh, gee, what should I do with my life? I'm too young to do nothing, and I thought, let me, go work with whatever. And I was talking to a guy on the golf course, and he's like, dude, if you know how to teach people how to make money, I mean, you should do it because then you're helping people geometrically. Like if a lot of people are giving money, then a lot of people can give money to charity and to good causes and pay for their kids to go to college and so forth and so on. But again, once again, might I digress? Let me go back into this here. So we're back to a really important level. And I don't want you to get too focused on this because this is an important level. So it could take a few days or a week or so to get through it. But if it's going to, it would probably take less time if it's going to go lower because markets go lower faster than they go higher because selling is based on fear and buying is based on hope, and fear is a more powerful emotion. Now, when we look at the S&P or the spider, we have to understand that there are 11 different sectors. This is the aggregate of 11 different sectors. And certain times, different sectors are in control. Different sectors are in the driver's seat. Sometimes it's the financials, sometimes it's the healthcare stocks, sometimes it's consumer discretionary. It switches. It switches. Now, obviously, over the last few days, the financials have been the driver of the market. So let's go look at a couple of these sectors. When you look at the sectors, you can almost think of it like, oh, all right, I'm looking behind the scenes, or I'm looking behind the curtain, or under the cover, or whatever your analogy is. And then I'm not going to get into tonight, but to take it a little bit farther, if you want to know what the sector is going to do, it's a good idea to look at the industries that make up the sector. For instance, when we were talking about how the financials looked really weak last week, I mean, I didn't know that this bank was going to melt down, but I saw a weakness in the financial sector. Most of that weakness was coming out of the banking industry. Did people know what was going to happen, and was their selling responsible for putting the market in a weak place? I don't know. Sometimes I think no, sometimes I think yes. I don't know. But did you guys see that? Oh man, I think it's the CEO is going to be investigated for selling last week or whatever. All right. By the way, if you're listening to this in the future, this is March 14th, 2023. All right, now here we have the technology sector, which is the biggest sector in the market. But you can see here over the last couple of weeks, it's been really kind of volatile. So this sector hasn't really been in control. A lot of times tech is, but it hasn't been over the last few weeks. But once again, we can see resistance becomes support. There's that seller's remorse. Resistance becomes support. Remember, that comes from seller's remorse, right? People sell. They regret doing so when the price moves higher. They tell themselves, oh, gee, I made a mistake. I'm going to buy my shares back. And if there are enough of them placing their buy orders at the level that was resistance, well, the level that was resistance converts into support. So this is getting kind of choppy. Let me move on to the next sector. Now here we have healthcare. This is the second biggest sector in the market. It's not as exciting as tech is, but remember, levels that were resistance can turn into support because of seller's remorse. So there's the resistance. Here's the support. Levels that were, oops, I'm just trying to get my pen back here. Levels that were support can turn into resistance because of buyer's remorse. People bought and they regret doing so. They decide they want out. Now, this is kind of important because this is the second biggest sector in the market. It's testing important resistance. Now, if this fails, meaning it doesn't get through, there's a good chance we go lower. This is because a lot of the investors who wanted to sell at the resistance level, they start to get the sense that there are other sellers lurking in the wings. That's why the shares or the price stop going higher. And they start to get nervous that they're not going to be able to sell because someone else might have a lower price. So they start to undercut each other, and it turns into like this snowball effect, like it just happened here, right? Didn't get through the resistance, big sell-off. That's one reason why it's important. One of many reasons why it's important to know where the important levels are, because when markets get to them, they tend to make tradable moves, either up or down. An important level is like a fork in the road. All right, so now I am going to look at the sector that has been driving the markets over the last few days. And this is financials. And obviously, if you're listening to my voice and you haven't been under a rock, you probably know about the banking stuff that's going on. But after somewhat of a reversal, we stalled out at this important level here. So here we have support becomes resistance. Buyer's remorse, people buy here. They regret doing so when the market goes lower and they want to sell the same price. Resistance becomes support. Seller's remorse, people sell. They regret doing so when the price goes higher. They want to buy their shares back at the same price. Resistance. So this is an important level. So we'll see over the next few days whether this breaks through. But I would say if you're trading the market, even if you're trading SPY, this is probably the most important thing to focus on. over the next few days, because I think what happens here, whether it goes up or down, is going to determine the direction of where SPY goes. All right, thanks everybody. Sorry for taking too long, but I hope I help you make money, and I will talk to you soon.